Owning real estate can be extremely lucrative, and trust me, I know, because I prepare tax returns for people that own tons of real estate, cash in your pocket. However, if you don't want to share your money with IRS, you need to make sure you're operating under the right entity and using the right strategy. That's why in this video, I am literally going to give you the ultimate real estate tax strategy to make sure you're keeping as much of your real estate profits as possible in your pocket. But before we jump in, I want you to like, comment, and subscribe so you don't miss out on any business changing information. And here's the thing. If you stay until the end, I am going to show you how to have an audit proof real estate strategy. Now, let's get after it. Owning real estate has major perks, and this is how the wealthy build wealth. The top 5 benefits of owning real estate are: number 1, tax-free cash flow coming through the door. Number 2, future appreciation of your property going up in value, up. Number 3, you can build a tax-deferred real estate portfolio. Number 4, you have tenants paying your rent, paying your mortgage. And number 5, you get to travel the world and take as many business expenses as necessary, like depreciation, hotel, stay in some swanky places, and see some nice things. Here's the thing, none of these benefits will help you if you don't have the right real estate strategy. You have to also remember what the right strategy is for you might not be the right strategy for someone else. So you really got to think it through, because there are a lot of variables: your financial strength, your credit worthiness, your temperament for risk, the time that you want to put into managing it. It all depends on the season of your life. If you are in that season where you're in your build years and you grinding, there's another level of thought that needs to go into it. I encourage at least buying 1 rental property. And trust me, speaking from experience, you'll be glad you did. Once you start buying real estate, you will be considered a real estate investor. Once you start buying real estate, one of the strategies I am going to recommend you consider is qualifying as a real estate professional. When I say real estate professional, I'm not talking about being a real estate agent. I'm not talking about showing up in professional clothing. I am literally talking about a tax code of being a real estate professional that gives you the ability to write off as many deductions as possible. In addition, on top of building great depreciation, which allows you to recover the cost of purchasing real estate. However, although buying real estate is something every investor should consider, being a real estate professional may not be for everyone who gets into real estate. This is a great planning tool, but not the first planning tool. This is doable when you own at least 2 pieces of property. And being a real estate professional helps you, especially if your income is over $150,000 per year. You are not even able to take any of your real estate losses. So being a real estate professional can help you, and that's really important. Now, how do you classify real estate investors? What constitutes a real estate investor? Number 1, the first classification is that of a passive investor. This is where you are investing in real estate. You really aren't doing anything but getting your checks in the mail. I'm not mad at you for that, though. Getting your checks in the mail, you are a passive investor. Number 2 is an active investor. This designation allows you to be able to deduct up to $25,000 in real estate losses against ordinary income, W-2 income, other income that is on your return. An active real estate investor can deduct up to $25,000 if they make $100,000 and below, and if they're married filing joint, $150,000 and below. That's why it's so important to qualify and to do the simple things that you need to do. You have to be involved in making decisions regarding your real estate, and you have to make an election on your tax return that you are going to be actively participating in the real estate. That is really important that you do that. The third classification is actually the real estate professional. And the real estate professional is an individual that is managing their own real estate. You don't have a property manager. You are literally going to be able to deduct 100% of any losses you may generate from your real estate if you qualify. And that is going to be the key component. How do you qualify as a real estate professional? To meet this threshold, which is really important, a taxpayer has to materially participate and pass a 3-part test. The first part is you must spend the majority of your time in real estate and on your real estate business. The second thing is you have to spend a minimum of 750 hours per year on your real estate. This is very important, and you have to be in an occupation associated with real estate. So for example, you might be in an occupation where you are managing your own real estate. You might be a real estate agent, but you don't have to be. You just want to make sure that you are setting up some type of entity that is a business that is putting you into that occupation of being a real estate professional. The third test is that you have to materially participate in the management of the property. Material participation means feet on the street. You're at the property, your feet are there. You're not in California managing property in New York. You are at the property. And there are literally 7 different tests in which IRS looks at to see if you are a real estate professional, to see if you fit into those categories. The thing that you want to make sure of, if you're going to qualify yourself as a real estate professional, do not have a property manager. That is one of the first things I am going to tell you. And if you have a property manager, do not deduct any property manager fees. That is very critical. You need to be the person that is looking for tenants. You need to be the person that's there in the event that something goes wrong with the real estate. You have to actually be there to take care of that real estate. That is a true meaning of a real estate professional. You're materially participating. You're putting your time in more than anything else you're doing, and you're putting in at least 750 hours of your time. The benefits of being classified as a real estate professional means you're going to be able to take 100% of your losses against any other income on your return. It doesn't matter how much money you make. You could be making $500,000. You could be making $1 million. You can be making $350,000. You will be able to take your losses against that income, and you won't be capped at that $150,000 threshold. That's really the key. But you want to make sure that you're not being classified as a dealer. A dealer is somebody that is purchasing real estate and they're flipping out of it. Purchasing and flipping. Purchasing, building on, and flipping to make money. If you're doing that, you're going to be classified as a dealer, and you do not want to be classified as a real estate professional if you are a dealer. And the reason why I say that to you is because they go against each other. A real estate professional is someone that is managing their real estate for the long haul. A dealer is somebody that is flipping their real estate, making money, grabbing profits quick. They're buying, fixing, flipping, buying, fixing, flipping. So you want to be very careful. Decide who you want to be when you grow up as a real estate professional. The other thing I want to discuss with you is the ability to be able to own your real estate tax deferred forever. And that is because of a wonderful code section called Code Section 1031. This code section allows you to sell one piece of real estate, get a profit, roll that profit into the next piece of real estate, and level up. So let's say we buy our first house for $300,000. We sell it for $400,000. We got $100,000 worth of profit. Now we're going to take that profit and go buy a house for $800,000. And we keep doing it and doing it and doing it and leveling up. But here's the key, my friends. If you are going to do a 1031 transaction, you are never, ever taking the money out and putting it in your pocket. You're always going to use a third-party accommodator to transfer the money from one escrow to the other escrow. You're never taking the money by yourself. It's very important. But how do you get that tax-deferred income? You're going to do a cash-out refinance. Whenever you get appreciation, you can always cash out, pull a loan out, and put that cash in your pocket, and that loan is not taxable income. That's what I love about real estate. It allows you to do so much tax-free, great appreciation, great write-offs, great travel, build wealth, and who doesn't want to do that? I also told you, if you stay to the end, that I would tell you how to make sure that your real estate strategy is audit free. Here's the ticket. You want to make sure that when you go to your real estate, you take a picture. All of us are always on our phones. Now's the time to make it Instagram worthy. Take a picture every time you are physically located at your real estate. You can never dispute a picture says 1,000 words. Some of you may be thinking, oh, I could just Photoshop myself there. No, no, no. We do things in integrity. Take pictures that can back up to your flight tickets, that can back up to your travel tickets. The reason why I tell you that, because I want to make sure you're operating in integrity. And when you know better, you absolutely have to do better. That is why I want you to like, comment, and subscribe so I can keep you updated on all things tax.